The volatility that we anticipated this year arrived earlier than expected, shortly after kickoff in February rather than in the second half, the start of the conflict in Iran. Our expectation for credit to provide a layer of resilience to portfolios, acting as a defensive anchor, is certainly advancing beyond group stage. Despite multiple once-in-a-lifetime events taking place in the first half of 2026, investment-grade credit in the US and Europe traded in a range of 20 to 25 basis points from the tights to the wides, while high-yield credit traded in a range of around 80 basis points. For context, this range was around 1,500 basis points in the year the GFC started and 700 basis points during the height of the volatility during the pandemic. For better or worse, the action has been in the rates market, where the market is starting to price the inflationary impact of the conflict in Iran. Our key strategy for the second half is to not get caught offside by chasing tight credit spreads. That rates market action will have an impact on credit, but with a lagged effect. We are already seeing more levered credits with significant refinancing needs underperform from a spread perspective, and this has the potential to bleed through to the broader credit market. Credit fundamentals were sound going into the conflict, but the direction of travel is likely a deterioration, more so in Europe than in the US. We are carefully watching the data at a macro level to better understand where credit might trade to, and then also at a micro level for companies with heavy exposure to oil as an input cost and significant near-term refinancing needs. We are biased to remain up in quality with a focus on income. Even with all of the action we've already experienced in the first half, there is the potential for even more action to come in the second half. The ongoing conflict in the Middle East, a new Fed chair, and the ever-present potential for yet another geopolitical risk event all have the potential to impact the credit market and the broader fixed income market. We are staying patient and waiting for the right opportunity to take our shot from a beta perspective.